welcome and welcome to another Coronation podcast. I'm joined today by Mr. Akin Adeniyi, Chief Relationship Officer of KingsThrones, which is an independent financial advisory firm regulated by the SEC. Mr. Adeniyi, welcome.
Thank you very much, Guy. It's always a pleasure to be here.
And it's always good to have a good old friend with us talking through the topics of the day that affect our investments and our markets. So the topic of the day is about dividends, and we've been writing about this a little bit in Coronation, and in particular the way that dividends affect equity returns and the fact that equity returns are a hot debate right now. We've had a great market in the NGX exchange for 4 years. We have another bull market happening in 2024. And in the long term, the results don't look too good on the face of it, and equity investors don't seem particularly enthusiastic. Mr. Adeniyi, could you tell us more about that and how that works?
All right. Thank you very much for that, Guy. Let me take it from the premise of your most recent report. I see a lot of issues raised trying to address the performance of equity, particularly the Nigerian market, the Nigerian capital market. Basically, we look at the feature, the nature of equity, volatile in performance, but over the long term, how do you assess, how do you evaluate the performance of the asset class itself? The report, that's the research report, comes with a lot of insight, but then, as we always know, research takes a look into the past. It's always after the fact. I'm supposed to be answering the questions, but I hope you wouldn't mind if I ask just one now.
Please, yes.
I want you to look at your report in form of your performance track record.
Okay.
How would you feel putting that into the market as a performance report rather than a research report?
Well, we would love to do it because we managed to get together a group of companies with superior return on equity, which we rate, we have a bar and you have to rate above 20% ROE consistently. And there are only about 10 companies that pass that bar. And then we track the performance from 2016 to the present day. Now, the overall performance was quite good. With dividends reinvested, you got a return of over 30% over those 8 years. But it's a volatile sequence. And this is where things could get problematic. For example, in 2022, the return of that portfolio was just 7.8%. The market was much stronger. So sometimes over the long term you could say it's a good sell, but in some years it's going to be a hard sell.
Okay, I like that. There's a reason behind that question. Looking at the research report in form of a performance presentation. And it's one thing that I've always harped on when it comes to investing generally. I talk a lot about gifts as well. All right, that is your performance presentation, the quality of it.
Yeah.
Now, you looking at attracting prospective investors.
Indeed.
You've also raised the issue, the concern around why equity participation in the Nigerian market has been abysmally low. All right. Perhaps we could go out and ask investors directly, why aren't they investing in equity? In the mutual fund space, we know what the distribution is like, right? In terms of asset classes. Equity is very low. When you go to the pension funds as well, it's barely 10%. Perhaps we could also ask the pension fund managers directly whether there are challenges around investing in equity. But I put it to you that the long-term return on a particular asset class, not just necessarily equity, is a pointer to what prospective investors want to see. So I will expect more investment managers doing much more of reporting of what they've been able to achieve in the past as a track record.
Yes.
As a track record. So if we were selling this research report in form of a performance report, perhaps over the last, should I say, 5, 10, 15 years, institutional investors particularly will have been much more interested. Institutional investors particularly, starting with our pension funds.
I think that's absolutely right. I think what we're driving at here is engagement between true long-term investors and truly profitable companies.
Exactly.
And they really should have a strong relationship. And it seems that they don't. And what we're trying to get to here is, why don't they? As you say, probably less than 2% of the mutual funds under management in this country are in equity.
Yeah.
Probably under 10% of the pension funds in this country are in equity. And yet there are equities that perform extremely well. And there are companies, we identified 10 of them in our report, that perform extremely well over the long term. So you would expect there to be a relationship between the two. I think the problem here is that there have been some poor years of equity returns. I'm thinking of years like 2014, 2015, 2016, 2018, 2019, where perhaps pension fund managers of this generation just switched off and thought, well, I'm going to lose money in equities, I'm better off in bonds and T-bills. The problem there, of course, is that that period was followed by a 4-year bull run, 2020, 2021, 2022 and 2023, and obviously the pension funds should have had more exposure to equity during those years.
Yeah,
that's the point.
Interesting. Now, I want to draw your attention to a critical aspect of the report that focuses on the strategy. That's the high yield dividend strategy.
Yeah.
That's just one. That's just one of the many factors in the equity market. And like I said, it's retrospective. Now, equity performance, whether it's poor in a particular year or good in another year, will require us to do some further analysis. Break down the factors.
Yeah.
When you look at a poor performance in a year, in a particular year, you want to do some evaluation.
Yeah.
Not necessarily all the factors performed poorly.
Correct.
Focusing on the dividend strategy, your research report shows clearly over a particular period of time how high dividend yield has been excellent.
Yeah.
Now, we say hypothetically, how many managers pursued this strategy? How many managers? Do we have any? That we can now begin to question further, that had it been you took this strategy, this would have been your result. Now, there are other factors. You're quite familiar with, size, value, growth, and so on and so forth, right?
Yeah.
Which of these did our managers pursue within this period to generate such performance? It's very important. It's a critical aspect that I always speak to during our investment consulting engagements. It's all about your philosophy, the execution, and the outcome. If we don't have the opportunity to analyze as you have done in the report, this is the challenge we are going to be dealing with going into the future. And that was why I raised the first question. If somebody had come out with this performance as actual performance, not hypothetical, what would we have been discussing here today?
So as you say correctly, it's about philosophy, execution, and performance. And if you look at the philosophy, that's kind of the easy bit to do. You just have to go back into the data.
Yes.
You have to get the dividend record of these companies over as long a period as you can. We found 8 years worth of information. and then you couple that together, you reinvest the dividends in the stock each year going back, and then you measure the stock price performance too, and you come up with a strong performance of that group of 10. In terms of execution, there are some issues here. You mentioned size, for example. So size is a difficult one because not all the shares of these companies are that liquid on the Nigerian Stock Exchange. So if we go through the 10 stocks in that portfolio, I'll list them now. It's Dangote Cement, it's then the Nestle Nigeria, then you have the 3 banks, Zenith Bank, GTCO and Stanbic, then Dangote Sugar, Nascon, Okomu Oil, Presco and Custodian Investment. Now, just from that list, you probably recognize the fact that some of those are not very liquid names. So this is where the dialogue comes in. You have to have more of a dialogue between the big institutional investors saying, well, if you float more shares, we'll buy them, we'll hold them for the long term. It's safe to do that. And of course, that could be a way of raising money for the companies themselves. So dialogue comes into the execution too. As for performance, this can be difficult because you're looking at a long-term investment. So over the period that we measured, you get a 30% compound annual growth rate, which is excellent. That beats inflation. But in some years, it's not going to be good. In 2022, the portfolio returned 7.8%, which is not particularly good at all. But then it did spectacularly well in 2023, as many other indices did. So it's a matter of persuading people that they are genuinely long-term investors. It shouldn't be measured on a one-year view, and that they've really got to take a courageous long-term view to get into these stocks.
Yes, you are very, very correct. And I'll take it from the last point that you made. The long-term effect. It's not a short run. But then I don't think that dialogue should be limited to the institutional investors. It goes beyond that. I think from your research, one thing that I found that probably we need to include next time is the trend in our dividend pool. Now, we have about 9 companies that you have identified, right? Now, what is the trend of the dividend pool? You know, over the years, has it been growing or has it been reducing? Are we having more dividends, cash dividends? So it goes beyond the investors, it goes beyond the managers. It should also get to regulator and macro policies. If we have incentives for companies to pay more dividends,
I see.
do you get?
Yes, I see your point.
If we have incentives for companies to pay more dividends, then we're getting somewhere. So I quite understand the concern around a float that will not allow people to execute this kind of brilliant strategy, all right? But beyond that, if we're saying the dividend strategy, then we must have an upswing in our dividend pool in the Nigerian market.
So in general, the dividends are going up, particularly among the financial services companies and the agricultural companies that I mentioned. They have policies of getting their dividends higher and higher. So in general, you have an expanding dividend pool. However, you've raised an important point, which is, of course, that while for pension funds these dividends can be paid gross, individual investors have to pay withholding tax on these. Now, to have a form of financing where you have to pay tax, whereas debt is, of course, tax deductible, is going to skew things a little bit. So you would want to have a system whereby people who are genuinely holding for the long term can reinvest their dividends gross. I think that would be an important policy that could help things along. From the company side, I think they should also have some incentive to keep on paying out.
Yes, I mean, the other important issue that I wanted to speak to has to do with, I mentioned earlier on, the macro policy, the tax aspect of it. More of debt, of course, has tax benefits to the company, all right? Whilst, taxes on dividend will be borne by the investors themselves. But the way the tax system currently works, That's the Nigerian taxation now. I'm not sure we're going to be having much more incentives coming in that direction. I think that came around not quite 2 or 3 years ago. That's the capital gains tax for dividends on the stock exchange. So the concern is the rate of increase in the dividend pool. Is it enough? Is it enough that it brings in more companies to this group that you have identified? So it is not so much of executing the policy, but being able to replicate that performance year on year.
That's right.
You need to be able to repeat that performance.
Yes.
And if you don't have that significant growth in the dividend pool, it becomes a difficult strategy to execute.
Yes, I agree. Now, there are 2 ways of getting around that. The first one is to be fairly conservative and say, look, we're not going to put a company in this portfolio unless it has a long-term track record of a return of equity above 20%. So it's probably beating its cost of capital in the long term. A company that's very profitable with a high ROE, that's a company that can pay dividends, and they tend to, and indeed they do, and indeed the dividend pool is growing. All that is squared off. However, some companies are going to drop out of your 10 top stocks. So you have to search around for new ones or ones waiting in the wings. And yes, we have our eyes on a few of those. More financial services firms who've reported very high ROEs last year. They had lower ROEs in 2022, so we want to see where the returns are settling down. And also some firms in the telco space, they're eligible too. There may be some issues with the way they calculate their equity, but basically, yes, you have to have a pipeline, and of course the relationship has to go there too. You have to say, well, you know, we do want to include this company in our core portfolio, but it's just a matter of how sustainable the ROE is going to be. I think what our research has shown is that if the ROE is truly sustainable and dividend policy is in place, then you will get these kind of high returns out of those stocks.
Certainly, and that takes me to the window of opportunity here in terms of product. Now, this addresses fundamental weighting. For instance, for an ETF.
Yes.
You don't have an ETF product currently, do you?
Not at this time.
Not at this time. But you know this is a pointer.
Indeed.
It is a pointer.
Indeed.
You know, this is one brilliant fundamentally weighted scheme for an ETF. I'm not too sure we have one on the exchange currently, like an index, fundamental weighting.
I believe we do. I'd have to check that out.
I haven't either, but it just occurred to me now that imagine you having run this for an ETF probably for the past 5 years.
It would have been fun.
It would have been great fun.
2022 would have been interesting, to say the least, as we got the phone call saying, why is it underperforming?
Yeah.
But over 5 years, evening out the returns, it would have been fun.
Yes, but generally, again, I just believe, and strongly too, that we need to do much more of information pushing in terms of performance now. All right, so that prospective investors can see things that are actually happening. I had this session, must have been around 2021 or 22, with quite a number of managers, where they expressed the concern that, well, the Nigerian market is not that type where you can uncover many factors of investing.
Yes.
I want to agree, because at the end of the day, I haven't been a player in the market before I went into consulting. You discover that most of what you have to do as an asset manager is controlled, or should I say, dictated by the client, the prospective client. So you get boxed into a corner. You fall into that rut of risk-free, risk-averse. But then we need to make it more fun. That if you do things like this, you can bring out more product ideas rather than just waiting for the miracle to fall into our laps. I think we need to do more of performance pushing, performance presentation, and I think the regulator also has a role to play. I tell you what, November 2022, if I recollect very correctly, 14th November 2022, the SEC US commenced the advertising rule. You can't sell an investment product without complying with the advertising rule.
Okay.
But what is the advertising rule? All right. I think it's about 50-60% GIPS.
Ah, yes. Well, that brings us on to...
So that's why I said the regulator has a role to play.
Yes.
Whilst you cannot enforce GIPS, you can make it work through kind of the back door like the US SEC has done.
Yeah.
So let the investing public have access to more information, not just ordinary information, credible, believable, interesting information. All right. I think until we are able to break these jinx, we still have a long way to go.
I think that's where I would certainly agree with that. So I think there's something of a conflict perhaps, or contrast, I would say, more than a conflict, between the fact that the people who set up funds and regulate funds want hard, fast rules to make sure nothing goes wrong.
Yeah.
Some of those rules are pretty tough, quite rightly so.
Very.
On the other hand, they can constrain people and they can constrain managers to play safe and too safe. What's the solution? I think, as you say, it's GIPS. It's getting the reporting across, getting these global standards accepted and implemented so you can see through your fund, see what it's doing, and come up with a mark-to-market view of where your investments are so that you have better visibility as to what is going on. So I think between the tough rules that we have now and a more flexible approach is a route, and the route is reporting and applying the international standards so
Yes.
the clients know where they are.
Yes, that is the point. I want most of our audience to take away from here. The Nigerian market is a market of opportunities. There's no doubt about that. And we can have that kind of growth we're looking at, or should I say that we desire, if we all come to an agreement on how we do things.
Yep.
We need to do things better than what we are doing now.
And in particular, how we report things.
Yes, I mean, when I got this report and I read it, it was just brilliant.
Thank you very much. It's very kind of you.
And the first question that came to me was the first question that I asked you. That, I mean, imagine this as a performance report.
Yes.
Take it seriously. So it's a track record. It shows what you have been able to achieve over time.
Yes.
And then there are other disclosures that I would have been expecting ordinarily under your reporting. Once those are there, what it gives the prospective investor is comfort by what we call the product description and then the product definition.
Yes.
Those are two critical things under GIPS. So it gives me a whole lot of understanding on what you are trying to sell to me. Do you understand?
I do. And I would add something as well.
Okay.
That the companies themselves need to get involved in this. I think they should be coming around and seeing pension funds and mutual funds and yourself, people like you, a lot more, doing roadshows and getting their message across. And if the fiscal authorities allow slightly better treatment of dividends, they have an incentive to do that. And they themselves have a further incentive that they can finance more through the equity market. Let's not forget in the US, there are some shares we can think of, particularly tech shares, which are currency. The employees of these large NASDAQ-listed companies are using the share register for their wealth building.
Yeah.
And that's the sort of culture that is so easy to create in an environment like Nigeria, where there's growth, there's opportunity.
Yeah.
You have people who can manage companies extremely well. Some of the ROEs are extremely high, and really nothing should be there to hold them back.
Yeah, I like that. Your comment on the U.S. market just also brought something to me quickly that you're probably aware, but if you're not, I'd like you to check. And that's the Chinese market A shares.
Oh yes, yes.
You're quite aware of A shares.
Yes.
So that is the whole idea.
Yeah.
That is what macro policies, or rather how macro policies help the Chinese capital market.
Yeah.
The A shares are given incentives for the dividend pool to grow.
Yeah.
And over the years, I think the last time I was reading a report on that, you see the phenomenal growth rate in what the dividend has been able to do.
Yeah.
So I think this type of discussion needs to be taken to, beyond this place, taken to other authorities for everyone to see what can be done.
Indeed.
The market operators, the FMAN, the regulator, the finance ministry, that is the coordinating ministry for the capital market anyway, so that, as far as market development is concerned, these are the types of things that we really need to encourage.
And I think we can both agree, in terms of corporate performance, the raw ingredients are there.
Certainly, sure, yeah.
Well, I must thank Mr. Adeniyi, who's been very kind, sparing his time to take part in this podcast. Mr. Adeniyi, are there any comments we need to clear at this point?
Yes, like I always encourage you, anytime I see any of your reports, you should keep it up.
Thank you very much.
This is another brilliant edition. And the suggestion that I made earlier on, when you coming out with similar one, in future, you should make it more, how do I put it now, available to the broader segment of the market. I don't know the current reach now, but I believe you should have a broader platform to reach wide and far.
We will certainly follow your advice.
This is a brilliant work. For me as an investor,
thank you.
If I had seen this 4 or 5 years before now, it would have been a done deal.
Right. Well, that's very good advice.
We don't do research.
Yes.
Research is very important. Research, in fact, what I tell people is that the quality of your research is what separates the boys from the men in the industry. So this is the kind of thing that we want to. And I'm sure you will also help a lot more institutional investors beyond pension funds. I am aware our pension funds are doing quite well. What they can do much better through equity as well. So much more of this will get us a long way. Thank you very much.
Thank you very much. Thank you. I should also mention that Mr. Adeniyi and I are sitting in the Coronation Gallery in Coronation Plaza, and we're sitting in front of a remarkable piece of work by...
That's Olumide Onodipe.
Which I wouldn't have pronounced correctly. It's a splendid piece of work. It's rolled up pieces of plastic, rolled up pieces of paper, rolled up pieces of aluminium, crafted into this fantastic piece of art called Spectators Gallery. And I would recommend a visit here.
Beautiful piece.